Hello everyone, welcome to Chapter 10, Financial Accounting 101, Reporting and Analyzing Liabilities. For the sake of this video, we will focus on explaining how to account for current liabilities. So what is current liability? Current liability is a debt that a company reasonably expects to pay from existing current assets or through the creation of other current liabilities, and payment is within 1 year or the operating cycle, whichever one of them is longer. Now, there are different types of current liabilities, which include, the notes payable, the accounts payable, unearned revenues, accrued liabilities, such as taxes, salaries, wages payable, and interest payable. Now, what is notes payable? Many times, companies record obligation in the form of written notes as notes payable, often used instead of the accounts payable because they give the lender written documentation of the obligation just in case there's any legal remedy that are needed to collect the debt. So also they usually require the borrower to pay interest and frequently are issued to meet short-term financial needs. So notes payable are issued for varying periods of time, and if due for payment within 1 year of the balance sheet date, or usually classified as a current liability. Now we have an example here, which is the First National Bank agrees to lend 100,000 on September 1, 2022 if Cole Williams signs 100,000 12%, 4 months maturing on January 1. When a company issues an interest-bearing note, the amount of assets is received generally equals to the note's face value. Okay, let's put that in mind. All right, so what we do first is to debit our cash because it's an increase in cash for Cole, and we're going to credit our notes payable, which is an increase in liability for Cole. And then we're going to treat our interest. The interest is calculated by using the formula, which is the principal times the rate times time. The principal is 100,000, the rate is 12%, and the time is 4 months, right? Which is divided by the 12 months, which is number of months that we have in 1 year. The interest which accrues over the life of the notes must be recorded when the financial statements are prepared on December 31st. Okay, so we have 100,000 times the 12% times the 4 months divided by 12, which gives us the 4,000. So we're going to debit our interest expense, which is increase in expense, and we're going to credit our interest payable. Okay, so accounting for notes payable. At maturity, Cole Williams must pay the face value of the note plus interest. So it is recorded as follows. So we have the notes payable, 100,000. We have our interest payable also, which is 4,000. And then the total of cash he's going to be paying to National Bank, which is going to be 104,000. So that is the principal plus the interest payable. That is the total of that is what cash is going to be paying to National. Sales tax payable. Many of the purchases in a retail store are subject to sales tax. Okay, so sales taxes are expressed as a percentage of the sales price. The seller collects the sales tax from the customer when the sales occur and then remits that tax they have collected to the State Department of Revenue periodically, many times, usually a month. Okay, so most states require that the sales tax collected be rung up separately on the cash register, but many times that may not be the case. So we have an example here. The March 25th cash register reading for Cooley Groceries shows a 10,000 and sales tax of 600 based on a sales tax rate of 6%. So in this case, it was rung up separately. So when the taxes are remitted to the state's taxing agency, the sales tax payable account is debited, and then the cash is what? Credited. So here we have a total sum of cash, which is 10,600 for the company. We have our sales revenue to be 10,000, and then we have our sales tax payable to be what? $600. Now, if taxes are not rung up separately on the cash register, divide total receipt by 100% plus the sales tax percentage to determine what your sales is going to be. So in this case, the sales was not rung up separately, so we have 10,600. We are dividing that by 100 plus our sales of 6%, which gives us 1.6, okay? 1.06. When we divide that by the total sales and combination of the total sales and the taxes together, that gives us 10,000. That 10,000 is the sale. Now that we have the sale, it is easy for us to determine what the taxes is going to be. It's going to be the sales minus the total amount that was received. So the total amount was 10,600. Our sales revenue is 10,000. Our tax would definitely be what? 600. Okay. Unearned revenue. Companies such as magazines, publishers, and airlines typically receive cash before goods are delivered or services are going to be rendered. Okay. Companies account for unearned revenue as follows. When the advance is received, both the cash and a current liability account identifying the source of the unearned revenue are increased. Then number two, when the revenue is recognized, right, the unearned revenue account is decreased and the revenue account is increased. So we're going to have another example. So we have a Superior University sells 10,000 season football tickets for $50 each for its 5-game home schedule. Entry for the sales of the season, right? So we're going to have a debit to cash, which is 500,000, and a credit to unearned ticket revenue, okay? And then as they begin to perform services, they begin to deduct it from the unearned tax ticket revenue. Okay, so as the game is completed, Superior records the earnings of revenue. So we have unearned tickets for 100,000, and then our sales revenue or ticket revenue is going to be credited with what? 100,000. All right, so the current portion of the long-term debt should be included in current liability portion of the balance sheet as long-term debt due within 1 year. Okay, it is not necessary to prepare an adjusting entry for this. In emphasis, or to say it again, so at the balance sheet date, all obligations due within 1 year are classified as current, and every other obligations are termed as what? Long term. So we have Wendy Construction issues a 5 years interest bearing 25,000 notes on January 1, 2020. This note specifies that each January 1, starting from January 1, 2023, Wendy should pay 5,000 of the notes. When the company prepares the financial statement on December 31st, 2020, what should be reported as liability? So the first thing is going to be 5,000, and the long-term liability is going to be what? 20,000. Okay, so don't forget at the balance sheet date, all obligations due within 1 year are classified as current, and every other obligation are termed as what? Long term. Okay. All right, so these are a couple of examples we're going to go through. You and several classmates are studying for the next accounting exam. Answer the following questions. If cash is borrowed on a 50,000 6-month 12% note on September 1, how much interest expense will be incurred by December 31st? Okay, so we're going to multiply that, the principal times the rate times the time. And here we have September, October, November, December, which is 4 months. So our in principal there is 50,000. Our rate is 12%, and the time is 4 divided by the number of months in the year, which is 12. That gives us 2,000. All right, question number 2. The cash register totaling includes sales taxes is 23,320 and the sales tax rate of 6%. What is the sales tax payable? Okay, we've told you before that once they are combined together, you add your 100% plus the sales tax rate to give you what the sales is. Once you have the sales, you are able to determine what the tax is, or the sales tax payable is. Okay, so here we have sales revenue 23,320 divided by the 1.06, and that gives us 22. So 22,000 is the sale. When we deduct the 22,000 from the total cash register, including sales taxes, that gives us sales tax of 1,320. Number 3, if 15,000 is collected in advance on November 1 for 3 months rent, what amount of rent revenue should be recognized by December 31st? So they collected in advance on November 1. So we have how many months in this year? November, December. So we only have 2 months out of the 3 months in this particular year. So it's going to be the 15,000 times the 2 months divided by the 3 months, which gives us 10,000. All right, payroll and taxes payable. Every employer incurs liability relating to employees, salaries, and wage payables, right? They also incur liabilities on withholding taxes, so that includes federal tax and state tax income, right? Payable and FICA taxes payable required by law to be withheld from the employee's gross pay. So until the withholding taxes are remitted to the government authorities, they are carried in the balance sheet as what? Current liability. So let's assume Cargo Corporation pays its payroll for the week of March 7 as follows. We have salaries and wages to 100,000. FICA taxes is 7,650. And then we have federal income tax payable of 21,864. State income tax payable of 2,922. Okay. And then when we add this together and subtract it from our salary and wage expense, it gives us what our salary and wage payable is going to be, which is 67,564. So every single time you get your paycheck, all of these things are deducted from your paychecks for you to be able to get your net salary and wages. Okay, record the payment of this period on March 7th. So we have salary and wages payable 67,564, and then we have cash 67,564. That is when payment is being made. So it's going to be a reduction in our liability and a reduction also in our cash. All right, so payroll expenses result from 3 taxes that the government agencies levies on employers. So when we deal with payroll expenses, we are dealing with expenses that deal with the employer. So these are the FICA taxes and the federal unemployment tax and the state unemployment taxes. So take note of it when you see them in questions. Only these ones form or sum up what our payroll expenses is going to be. Okay, so based on the Cargo Corp 100,000 payroll, the company will record employer's payroll tax expense and liability for the payroll taxes March 7 as follows. So we have payroll tax expense of 13,850. How did we have this amount? We added up all the expenses, the 3 things we talked about, which is the FICA tax payable. Remember, you did take this amount 7,650 from the employee, and also the employer has to match the same amount. Okay, so when you're answering questions, don't forget when you're doing the payroll tax expenses to include the employer's portion of the FICA taxes payable. Okay, so we also have the federal unemployment tax payable 800, and we also have the state unemployment tax payable, which is 5,400. Okay, when we added all that up, that is what gave us the 13,850. Okay, All right, so this is an example. During September, Lake Corporation employees earned wages of 600,000. Withholding related to these wages were 4,590 for Social Security, that's FICA, 6,500 for federal income tax, 2,000 for state income tax. Costs incurred for unemployment taxes were 90 for federal and 150 for state. So these two are for the employer's payroll expenses. Okay, salary and wages expenses are payable assuming all September wages are paid in October. Okay, so we have salary and wages expense, which is 60,000. Sorry. FICA tax payable is 4,590. Federal income tax payable is 6,500. State income tax payable is 2,000. And then when we add up all of that, subtract from 60,000, it gives us a salary and wage payable of 46,910. All right, so now we are told to prepare the company's payroll tax expense. Again, when you're solving problems like this, don't forget to include the employer's portion of FICA. Okay, don't forget. Don't forget. All right, so here I know they always show the debit side to be 4,830, but remember that it's only the addition of this. So the employer part is the 4,590, the employer's federal unemployment tax payable 90, and then the state unemployment tax payable is 150. When we add that up, that gives us what we have there in the debit side, payroll tax expense of 4,830. Just for the sake of emphasis, again and again, do not forget to include the employer's portion of the FICA taxes. All right, so that brings us to the end of learning objective 1. I'm going to see you in learning objective 2, where we will be describing the major characteristics of bonds. See you then.